Hi everyone, Matt Rosenberg with RoseCap Financial here. I hope you're having a great summer so far, and I wanted to send a quick video just because the stock market's been sliding quite a bit over the last few days, and one of the reasons why I think is because it's essentially pricing in a high probability of an upcoming recession. So a recession is when the economy experiences 2 consecutive quarters of negative GDP growth or just slowdowns. And understanding the definition of that is important because it's really not defined by anything that has to do with the stock market. Now that said, the stock market tends to be a forward-looking indicator of the economy. And what that means is that the stock market tends to go down before an economic slowdown actually occurs or in anticipation of one. And then the stock market tends to go up before or in anticipation of economic growth. So given the nature or the forward-looking nature of the stock market and considering how much it's already down this year, I think it's a very fair question to ask how far is it going to go down if it correctly prices in a recession or anticipates one. And as always, if I knew the answer to that question and I could predict it with certainty, I wouldn't be doing this for a living. But what I can do is give you some information on it and the things we're looking at, and then also tell you some strategies we would take to deal with this uncertainty as they relate to your financial goals. To do this, I want to show you a chart of the historical stock market performance as measured by the S&P 500 going all the way back to the 1950s. This chart is a little different though because it shows the index history as a percentage of all-time highs. And so the most recent all-time high of the S&P was hit right at the end of 2021, and that's shown right here on the graph by the zeros. So every time the purple line touches the zero line, that means the stock market's hitting an all-time high. And you can also see that as of me making this video at the end of trading on June 14th, the market's now down about 22% since that all-time high. So there are a couple key takeaways from this, and the first one is that we can use this chart to estimate how much the stock market tends to go down around a recession. And so what I did is I overlaid the recessions for the last 70 some years on this chart, and those are the gray bars here. So you can see wherever there's a gray bar going through, those are years where the economy was in recession. And so if I look back, the first one here, 1953, the stock market went down about 11% at its bottom. 1957 is the second one, down about 18%. 1960 down about 5%, and I can kind of keep going through these different recessionary periods of our history to see how much the stock market declines. The two biggest are going to be 1974, which is right here, where the stock market went down around 40%, and then 2008, which was obviously more recent, the financial crisis, where we went down over 50% from the all-time high. Most of the time, though, the recessions result in about a 15 to 25% stock market decline from its all-time highs. And so considering that information and that we're down 22% already, I think there's at least a significant amount of the recession currently priced into the stock market. The second takeaway is that if you look at how steep the rebounds are, the economy or the stock market tends to come back quickly as the recession gets nearer towards the end. And so that's for these reasons, that's why I think it doesn't make sense to try to time these markets and say, let's get out of the market and wait until maybe things get better. By the time things are better, that forward-looking stock market has already gone back up. So now this is a chart of the same stock market index, the S&P 500, going back over the same time period, but now it's just the actual level of the index, not showing it as a percentage of its all-time highs. And this illustrates my point that if you invest in stocks over a long-term time horizon, then you tend to make a lot of money. And you can see how many recessions there are throughout the history of the S&P 500. 1, 2, 3, 4, 5, 6, 7, a lot of them, maybe 10 or 12 in the last 60, 70 years. And in each of those, it felt like things were really bad, and I'm sure it was tempting to get out of the market. But even in the worst one I remember, which was the financial crisis 2008, you can see for the people who said, I'm going to stay in this, how much growth there was in their portfolio. So there still could be more downside to come, but in my opinion, and as history shows, trying to avoid that downside by selling out of the market isn't worth the risk of missing the upside whenever that recovery occurs. And this is because, as that last chart shows, the market has a very high probability of going up over a long term. And so if you have stocks in your portfolio, then at least part of your financial goal should be longer term, meaning you aren't planning on spending all of the money or 100% of it in the next 7 to 10 years. The reality is that most RoseCap clients have goals that involve a mix of investing for long-term growth and short-term safety. And that's why you likely have a mix of stocks and bonds in your portfolio. And that's also why it's highly unlikely that your portfolio would be down 22% so far this year like the market is. That said, making sure your portfolio allocation matches your financial goals is very important. And if your financial goals have changed, then it's also very important that you let us know that right away. In the meantime, you can be sure that even though we don't control the markets, we're doing everything possible to increase your chances of a faster recovery whenever that does occur, like rebalancing, lost harvesting, tactically shifting fixed income duration, and so on. Of course, if you have questions or you would like to discuss your portfolio with me, please don't hesitate to give us a call or come in. It's always great to see you. Thanks.